Marketing Strategy, the architect of market power. Segment 1. Introduction of Introduction to marketing strategy and tactics. Marketing is not advertising. Marketing is not social media posts, logos, or catchy slogans. Those are surface level instruments. Marketing strategy is the deeper structure that determines how a company captures attention, converts demand, defends territory, and extracts profit over time. Most businesses fail because they confuse activity with strategy. They mistake movement for direction. They spend money on tactics without understanding positioning, resource allocation, competitive advantage, or market structure. The result is predictable: wasted capital, weak differentiation, and gradual irrelevance. A marketing strategy is a long term pattern of decision that determines what a business will achieve, where it will compete, and how it will deploy resources against competitors and environmental pressure. It is fundamentally concerned with objectives, market focus, and competitive methods. Our strategy answers three brutal questions: what must be achieved, where must the organization fight, and how can victory be sustained? Everything else is secondary noise. Tactics, by contrast, are operational actions. Strategy determines the battlefield, tactics determine the maneuvers used on that battlefield. Strategy is the architecture, tactics are the tools. A company without strategy becomes reactive, fragmented, and dependent on short term impulses. Employees begin optimizing isolated metrics while the organization itself drifts without coherence. This is one of the most common corporate failures in modern markets. Tactical overload combined with strategic emptiness. The distinction between strategy and tactics becomes clearer when examining competition. Strategy creates competitive advantages. Tactics merely execute temporary actions. A business may launch advertisements, discount campaigns, influencer partnerships, or social media promotions. But without strategic positioning, these activities produce only temporary spikes rather than sustainable dominance. A company that constantly changes tactics without a strategic foundation resembles an army fighting randomly without understanding terrain, supply lines, or long term objectives. An effective marketing strategy also controls resource allocation. Every organization operates under constraints of money, time, labor, managerial focus, and operational capacity. Strategy determines where those scarce resources should be concentrated for maximum impact. Weak firms distribute resources evenly in an attempt to satisfy everyone. Strong firms concentrate resources aggressively into areas that generate disproportionate returns. This concentration principle explains why many market leaders appear dominant despite having fewer total resources than fragmented competitors. Precision defeats dispersion. Another central failure of strategy is long term orientation. Tactical thinking obsesses over immediate visibility, temporary engagement, or quarterly numbers. Strategic thinking focuses on positioning that compounds over years. This distinction separates enduring organizations from unstable ones. A business that sacrifices long term brand equity for short term sales discount eventually trains customers to value price over quality. Once that conditioning occurs, margin erosion becomes irreversible. Marketing strategy also defines target markets, audience, and product priorities. Not every customer deserves pursuit. This is where segmentation, targeting, and positioning becomes essential. Organizations must identify which market segments possess the highest profitability, strongest strategic alignment, and greatest long term potential. Attempting to appeal to everyone usually results in appealing strongly to no one. Strategic clarity often requires exclusion. Weak managers fear excluding customers because they confuse reach with power. Strong managers understand that positioning requires sacrifice. Brand positioning is another strategic function. Positioning determines how a brand exists within the customer's psychological map relative to competitors. Customers do not evaluate brand objectively, they evaluate them comparatively. Therefore, strategy must deliberately shape perception. Luxury brands emphasize exclusivity and prestige. Cost leaders emphasize efficiency and affordability. Innovation driven firms emphasize technological superiority. Each positioning strategy influences pricing power, customer loyalty, and market defensibility. Modern marketing strategy also increasingly depends on technological infrastructure. Data analytics, automation systems, customer relationship management platforms, and digital optimization tools are no longer optional supplements. They form the operational nervous system of strategic marketing. Firms that fail to integrate technology into their strategic framework lose visibility into customer behavior. market shifts, and performance efficiency. Eventually, slower feedback loops produce slower decisions, and slower decisions produce competitive decays. One of the most overlooked dimensions of strategy is governance and control. Strategy is meaningless if tactical execution becomes disconnected from strategic intent. Organizations require monitoring systems, performance metrics, reporting structures, and accountability mechanisms to ensure that activities remain aligned with objectives. Without control systems, departments begin optimizing their own interests instead of organizational goals. Internal fragmentation becomes inevitable. The deep reality is that marketing strategy is fundamentally about power accumulation within markets. Firms compete for attention, trust, distribution access, customer loyalty, pricing authority, psychological dominance. Every strategic decision either strengthens or weakens the organization's ability to control market outcomes. Companies that understand this operate emotionally and reactively. Companies that understand it designs systems that shape consumer behavior, constrain competitors, and create long term asymmetry. Most organizations never reach this level of strategic maturity. They remain trapped in short term tactical cycles because strategic thinking is cognitively demanding and politically uncomfortable. Real strategy forces trade off. It requires saying no to markets, products, consumers, and activities that dilute focus. Weak leadership avoids those decisions because exclusion creates internal resistance, but organizations that refuse strategic discipline usually collapses under operational complexity, marginal pressure, and competitive imitation. Thus, marketing strategy is not merely a business function, it is the coordinated logic of market conquest, resource concentration, and competitive survival. The firms that understand this becomes category leaders. The firms that do not become disposable participants in market controlled by others. Marketing strategy, the architect of market power. Segment 2, component and hierarchy of market strategy. A marketing strategy without structure collapses into improvisation. Many organizations speak about vision and innovation, yet internally they operate through disconnected decisions, departmental conflicts, and short-term reactions. This fragmentation occurs because they fail to understand that strategy is hierarchical. Every effective organization operates through multiple strategic layers that must reinforce one another. When these layers become misaligned, internal decay begins long before external collapse becomes visible. A well developed strategy contains five central components: scope, goals, and objectives, resource allocation, sustainable competitive advantage, and synergy. These components form the structural skeleton of strategic management. Remove one and the organization becomes unstable. The first the first component is scope. Scope defines the boundaries of organization's activities. It determines which markets the company will enter, which products it will prioritize, which customers group it will pursue, and which opportunities it will reject. Weak organizations expand without strategic coherence. They enter markets because competitors are entering them, not because they possess structural advantages there. This produces operational sprawl and resource dilution. Strong organizations define scope with precision. They understand exactly where they cannot dominate and they understand exactly where they can dominate and where they cannot. Scope is deeply tied to organizational identity. If a company cannot clearly define what business it is truly in, it eventually becomes strategically confused. A business selling premium handcrafted products cannot simultaneously pursue mass market discount positioning without destroying brand clarity. Contradictory scope decisions fracture customer perception and weaken internal execution. The second component involves goals and objectives. Strategic objectives establish measurable targets related to market share, profitability, growth, customer acquisition, brand positioning, and return on investments. Objectives transform abstract ambition into operational direction. Without explicit objectives, employees optimize random metrics, departments compete internally, and organizational energy disperses into non essential activities. However, objectives become dangerous when detached from reality. Many firms set aspirational growth targets without considering operational capacity, market conditions, or competitive retaliation. Strategy is not fantasy projection, it is constrained calculation. Unrealistic objectives force desperate tactical decisions that often damage long-term positioning. For example, a company aggressively chasing quarterly sales target may over-discount products, weakening brand value permanently. The third component is resource allocation. Every organization operates under scarcity. Capital, labor, managerial focus, production capacity, and time are finite. Strategy therefore becomes an exercise in prioritization under constraint. Weak managers spread resources equally to avoid conflict. Strong strategists concentrate resources where they produce asymmetric returns. This principle explains why market leaders often appear disproportionately dominant. They focus intensely on core strengths while competitors dissipate energy across too many initiatives. Resource concentration creates momentum. Momentum creates scale advantages. Scale advantages generate defensive barriers against smaller rivals. The fourth component is sustainable competitive advantage. Temporary advantages are meaningless if competitors can easily replicate them. Sustainable advantages require structural defensibility. This may emerge through technology, cost leadership, distribution networks, intellectual property, customer loyalty, operational efficiency, or brand perception. A company without sustainable advantage becomes trapped in permanent price competition. Once products become commoditized, profits margin collapse. The markets begin rewarding scale and efficiency rather than innovation or quality. Many businesses die slowly inside commodity markets because they fail to establish meaningful differentiation early enough. Competitive advantage also requires continuous adaptation. What creates advantage today may become obsolete tomorrow. Technological disruption, consumer preference shifts, regulatory changes, and competitor innovation constantly erode established positions. Strategic complacency is one of the most lethal organizational weakness because it blinds leadership to gradual deterioration. The fifth component is synergy. Synergy exists when different parts of an organization reinforce one another, then operate independently. Shared technologies, integrated supply chains, common disruption systems, unified branding, and coordinated market positioning all create synergistic effects. The importance of synergy becomes obvious when examining large corporations. Strong conglomerates extract value because their divisions strengthen each other operationally or strategically. Weak conglomerates merely accumulate unrelated business with no reinforcing capabilities. In those situations, complexity increases while efficiency declines. Beyond these five components lies the hierarchy of strategy itself. Organizations typically operate through three interconnected strategic levels: corporate strategy, business level strategy, and functional strategy. Each level addresses different equations, yet all must remain internally consistent. Corporate strategy operates at the highest level. It determines which businesses the organization should enter, how resources should be distributed across divisions, and how the overall corporate portfolio should evolve. Corporate leaders decide whether to diversify, consolidate, expand internationally, acquire competitors, or exit industries entirely. Corporate strategy is fundamentally concerned with capital allocation and long-term survival. Errors at this level are catastrophic because they affect the entire organization, entering structural weak industries. Overextending through acquisitions or misjudging technological shifts can destroy decades of accumulated value. The second level is business level strategy. This focuses on how a particular business unit competes within its industries. Here, the organization determines whether it will compete through low cost, differentiation, niche specialization, customer intimacy, or innovation leadership. Business level strategy translates broad corporate direction into competitive positioning. The key issue at this level is sustainable competitive advantage. Managers must determine which capabilities allow the business to outperform rivals consistently. A company with superior logistics may dominate through operational efficiency. Another may dominate through premium branding. Another may dominate through rapid innovation cycles. Strategic clarity is essential because contradictory approaches usually neutralize one another. The third level is functional strategy, particularly marketing strategy. Functional strategy focuses on specific product market decisions and operational execution. Market strategy determines target audience, product positioning, pricing frameworks, communication methods, distribution systems, and promotional activities. This is where many organizations become trapped. They focus excessively on functional activities without understanding their relationship on higher strategic layers. Marketing departments optimize campaigns while corporate leadership lacks strategic coherence. The result is tactical efficiency serving strategic confusion. Internal consistency across all three levels is essential. Corporate strategy defines the battlefield, business strategy defines the methods of competition, functional strategy executes the operational details. When these layers reinforce one another, organizations become structurally powerful. When they conflict, the organization enters a state of internal friction where departments sabotage each other unintentionally. This strategic hierarchy also reveals a brutal organizational truth. Most business failure originates internally before it becomes externally visible. Misallocation of resources, contradictory positioning, fragmented objectives, and weak strategic integration slowly erode competitive strength. By the time revenue decline becomes obvious, the structural decay is already advanced. Therefore, marketing strategy cannot be isolated from broader organizational architecture. It is embedded within a larger hierarchy of decision concerning power, competition, resources, and survival. Firms that understand this build coherent systems capable of compounding advantages over decades. Firms that ignore it remain tactically active but strategically fragile. Segment 3: Integration of marketing strategy with organizational strategy and market opportunity analysis. Most organizations treat marketing as a separate department rather than an integrated strategic function. This mistake produces internal contradiction. Finance pursues cost reduction while markets pursues expansion. Operations pursue efficiency while branding pursues customization. Sales chase short-term revenue while long-term positioning deteriorates. These conflicts are not accidental. They emerge from strategic disintegration. When marketing strategy is disconnected from corporate and business level strategy, the organization behaves like competing factions instead of a coordinated system. Marketing strategy must therefore originate in direct alignment with organizational resources, objectives, and competitive positioning. It cannot exist independently. Every marketing initiative depends on financial capability, operational execution, and technological infrastructure, managerial competence, and organizational culture. If the broader organization cannot support the marketing promise, the customer trust eventually collapses. This integration begins with understanding the role marketing plays inside strategic management. Marketing managers are responsible for interpreting customer needs, market shifts, competitor behavior, and environmental threats. They act as the organization's external intelligence network. Their task is not simply communication, it is strategic sensing. They identify opportunities before competitors recognize them, detect threats before they become fatal. Organizations that ignore marketing intelligence usually react too late to market transformations. At the same time, marketing managers cannot formulate strategy in isolation. Their plans must remain achievable within the organization's actual capabilities. A premium branding strategy is impossible if production quality is inconsistent. An aggressive market expansion strategy fails if supply chains cannot scale. A customer service differentiation strategy collapses if operational systems are weak. Therefore, strategic alignment is not theoretical coordination, it is operational realism. Integrated marketing strategy attempts to unify multiple communication tools and strategic channels into a coordinated system. Traditional advertising, public relations, social media, digital platforms, sales promotion, and customer engagement activities must reinforce a consistent message rather than operate independently. Fragmented communication weakens perception. Coordinated communication compounds influence. One major transformation in modern strategy is the collapse of rigid boundaries between advertising and public relations. Historically, advertising focused on paid communication while public relations emphasized reputation management. Today, these distinctions increasingly overlap. Social media platforms, influencer ecosystems, online communities, and digital content distribution have created an environment where communication is continuous rather than campaign based. This transformation has fundamentally altered market power structures. Customers no longer passively receive brand messages, they participate in amplification, criticism, reinterpretation, and destruction of brand narratives. A single viral controversy can erase years of carefully constructed positioning. Therefore, modern marketing strategy requires constant environmental monitoring and rapid adaptation. Social media intensified this shift further. Digital platforms reduce communication costs while dramatically increasing market reach. Small firms can now compete for attention against larger competitors using targeted messaging, viral content, and niche positioning. However, This accessibility also increases competition for attention itself. Consumers are exposed to overwhelming information density every day. In such an environment, weak positioning disappears almost instantly. This leads directly into the concept of market opportunity analysis. Market opportunities do not emerge merely because a market exists. They emerge when unmet demand, organizational capability, and competitive weakness intersect. Most organizations fail because they mistake market existence for market accessibility. A large market means nothing if dominant incumbents possess overwhelming advantage in scale, distribution, technology, or customer loyalty. Market opportunity analysis therefore becomes essential before entering new market or launching products. Its purpose is to evaluate the attractiveness, feasibility, and profitability of potential opportunities without systematic analysis. Organizations operate on assumptions and optimize on optimism instead of evidence. Understanding market opportunities require examining both external and internal conditions. Externally, organizations must study customer demand, industry structure, macroeconomic trends and political conditions, technological shifts and cultural changes, and competitive intensity. Internally, they must evaluate resources, managerial capabilities, operational capacity, and strategic coherence. Opportunities only matter when the organization possesses the ability to exploit them effectively. Market opportunity analysis addresses several critical questions. Which market segments are the most profitable? How rapidly is the market growing or declining? What competitive gaps exist? Which sustainable differentiators can the organization establish? Their questions separate strategic analysis from emotional speculation. One of the most important concepts within opportunity analysis is differentiation. If existing competitors already satisfy customer needs efficiently, a new entrant must provide meaningful distinction. This distinction may emerge through price, convenience, technology, branding, customer experience, specialization, or distribution innovation. Without differentiation, new entrants usually become entrapped in destructive price competition. Porter's five forces framework is often used to analyze industry effectiveness. This framework evaluates competition, rivalry, supplier power, buyer power, threats of substitution, and threats of new entrants. Strong competitive forces reduce profitability. Weak competitive forces create opportunities for higher margins and sustainable advantages. The threat of substitutes is particularly dangerous because it often emerges gradually. Companies usually monitor direct competitors while ignoring alternative solutions fulfilling the same customer needs. Taxi companies ignored ride-sharing platforms until disruption became irreversible. Traditional retailers underestimated e-commerce convenience until customer behavior permanently shifted. Another essential analytical framework is deep analysis, which examines social, technological, economic, ecological, and political determinants influencing markets. These macro environmental forces shape demand conditions, consumer behavior, regulatory environments, and competitive dynamics. Technological change is one of the most destabilizing forces in modern markets because it continuously compresses product life cycles. Competitive advantages that once lasted decades now erode within years or even months. Organizations incapable of continuous adaptation becomes obsolete regardless of previous dominance. Economic conditions also profoundly influence strategy. Inflation, unemployment, interest rates, purchasing power, income distribution all affect customer behavior and market potential. During economic contradictions, consumers become more price sensitive and risk averse. Premium positioning strategies may weaken unless supported by exceptionally strong brand equity. Political and regulatory conditions can reshape entire industries overnight. Trade restrictions, environmental regulations, taxation policies, labor laws, antitrust interventions, and influence interventions all influence market structure. Strategic planning that ignores political risk is structurally incomplete. Environmental scanning therefore becomes a continuous organizational necessity rather than a periodic exercise. Organizations must monitor both internal and external environments consistently. Internal analysis examines communication systems, operational capabilities, organizational culture, human resources, and structural efficiency. External analysis evaluates industry conditions, national economic trends, and broader macroeconomic changes. This strategic management process itself generally follows four stages: environmental scanning, strategic formulation, strategy implementation, and strategic evaluation. Environmental scanning gathers intelligence. Strategy formulation converts intelligence into decisions. Strategy implementation transforms these decisions into operational systems. Strategic evaluation measures performance and adjusts execution when outcomes diverge from objectives. Most organizations fail not because they lack intelligence, but because they fail during implementation. Strategies collapse when organizational structure, incentives, leadership behavior, or operational systems do not support execution. A company may intellectually understand market opportunities yet remain capable of exploiting them because internal systems resist adaptation. This exposes the deeper truth of strategic integration. Markets do not reward intention, they reward execution capability. A theoretically brilliant strategy without organizational alignment is worthless. Competitive advantage emerges only when analysis, resources, structure, leadership, and execution reinforces one another consistently over time. Organizations that master this integration build durable market power. Organizations that fail remain trapped in cycles of reaction, fragmentation, and strategic drift until competitors absorb their market position. Segment 4: Process of market opportunity analysis, strategic management, and market planning. Most businesses do not fail because opportunities do not exist. They fail because they misread opportunities, enter markets too late, overestimate demand, underestimate competition, or lack the operational discipline to execute effectively. Opportunity alone has no value. Exploitable opportunity has value. The difference between the two determines whether a business scales or collapses. Market opportunity analysis is therefore not a motivational exercise. It is a filtering mechanism designed to separate profitable possibilities from strategic traps. Many ideas appear attractive in isolation but become financially irrational once distribution costs, competitive responses, operational limitations, and market saturation are examined. Organizations that skip systematic evaluation usually substitute enthusiasm for evidence. That substitution destroys capital. The first stage is market opportunity analysis involves customers and competitor research. An organization must identify who the customers are, what they truly need, and how they currently satisfy those needs, and where dissatisfaction exists. Weak analysis focuses on demographic information such as age or income. Strong analysis studies motivations, frustrations, purchasing behavior, psychological triggers, and switching barriers. Customer behavior is often irrational and contradictory. Consumers frequently claim to value one thing while purchasing based on another. Therefore, organizations relying solely on stated preferences risk building strategies around inaccurate assumptions. Actual purchasing behavior matters more than verbal declarations. Competitive analysis is equally important. A market may appear attractive until the organization realizes competitors possess superior economies of scale, distribution dominance, brand loyalty, or technological capabilities. Many startups die because founders analyze demand while ignoring entrenched competitive structures. Markets are not empty landscapes waiting for innovation, they are defended territories occupied by organizations protecting revenue streams aggressively. After consumers and competitor analysis, organizations must develop a broad understanding of market structure itself. This involves evaluating market size, growth rate, customer volume, barriers to entry, supplier power, competitive intensity, substitution threat. Barriers to entry are particularly important because they determine whether profits can be defended. Industries with low barriers attract excessive competition, which eventually compresses margins. Digital markets frequently experience this phenomenon because technological accessibility allows rapid imitation. By contrast, industries require large infrastructure investments, regulatory approvals, or complex distribution systems are harder to penetrate and therefore often more profitable. Organizations must also explore adjacent opportunities. Many successful companies grow not by abandoning their core business but by extending existing capabilities into nearby markets. These adjacent expansions reduce risk because they leverage existing resources, customer relationships, operational knowledge, or distribution networks. For example, a company with strong logistics infrastructure may expand into related product categories because the distribution advantage already exists. This creates strategic efficiency. By contrast, unrelated diversification often creates complexity without synergy, leading to managerial fragmentation and operational inefficiency. Understanding broader business climate is another critical stage. Economic conditions, geopolitical changes, government regulations, cultural shifts, technological developments, and trade policies all shape opportunity viability. Organizations operate without awareness of the macro environmental conditions, expose themselves to external shocks they neither anticipate nor prepared for. Technological disruption deserves special emphasis because it continuously restructures industries. Entire business models can become obsolete rapidly when technological innovation changes customer expectations or operational economics. Firms that treat technology as a secondary concern usually discover too late that competitors used innovation to redesign the market itself. Organizations also require reliable market research data. Decisions based on intuition alone becomes increasingly dangerous in a complex market. Market reports, industry analysis, customer surveys, focus groups, and trend evaluations provide structural intelligence that reduces uncertainty. However, data itself doesn't guarantee strategic accuracy. Excessive information without analytical discipline creates paralysis. Strong organizations convert data into actionable strategic insights. Weak organizations drown in metrics while falling to make decisive moves. This strategic management process itself generates generally operates through four interconnected stages: environmental scanning, strategic formulation, strategic implementation, and strategy evaluation. Environmental scanning gathers information with internal and external conditions. This stage examines competitors, customers, industries, macroeconomic conditions, political risks, technological development, organizational capabilities. The purpose is not information accumulation for its own sake, the purpose is strategic awareness. The execution summary provides condensed strategic direction for senior leadership. The current situation analysis evaluates market conditions, competitors, organizational performance, strategic issues, identify critical threats and opportunities. Objectives define measurable targets, and marketing strategies determine how those targets will be achieved operationally. Action plans specify those responsibilities, timelines, and implementation details. Profit projections estimate financial outcomes. Control mechanisms track execution performance. Contingency plans prepare the organization for adverse scenarios such as market disruption and supply chain instability or collective retaliation. An important concept within market opportunity analysis is the distinction between total available market, serviceable available market, and serviceable obtainable market. Organizations frequently exaggerate opportunity size by assuming access to the entire market. In reality, only a fraction is realistically accessible due to operational limitations, competition geography, regulations, or brand recognition. Organizations frequently believe they understand their own market positioning. Most are wrong. Internal optimism, managerial ego, political distortion, and selective reporting creates dangerous illusions inside companies. Businesses begin believe their own narratives instead of confronting objective reality. This is precisely why marketing audits and forecasting systems exist. Their purpose is not comfort, their purpose is exposure. A proper marketing audit must therefore evaluate the entire marketing structure rather than isolated symptoms. Organizations ignoring macro environmental shifts often become obsolete gradually rather than suddenly. A strategy that succeeded 5 years ago may now be structurally outdated. Markets evolve faster than organizational psychology. Executives often defend old strategies because admitting strategic obsolescence threatens their credibility. This psychological rigidity destroys organizations more effectively than external competition.